Welcome to the Options Income Blueprint Weekly Income Report. This is Michael Schulman on October 31st, 2022. A reminder, we have trading tomorrow at 11. As you know, we had three great trades last week. I hope to do the same this week. I'm going to go over those results in a moment, and I want to juxtapose those results against goals. Goals may seem ephemeral. They may seem an excuse to not be very aggressive. It's the exact opposite of that. They're very hard, they're very fast, they're defining, they create discipline. And I just wanted to go over it in the context of the three trades we made last week. As you can see, we closed three trades, excellent rates of return, nice amounts of cash coming into our pocket. The net return was right on target. This is what I'll be going through in a bit of detail. Our target here is 0.5% a week. And when you take a look at the performance of individual positions, as well as the positions in toto, meaning the ones that you have in your portfolio, you have to keep track of both sets of goals, and those will tell you how to manage a position. Overall, we had a really rich week in cash because the amount of rolls that we put on, it's a fundamental part. If you're new, it's a fundamental part of this service is that we have core positions, and occasionally the position we have a hangover effect. It went against us. We roll those positions. We've sold a put. We buy it back. We sell another one. And the cash just keeps flowing in because this is a cash and income generation service. So last week the goal for the week, as I said, cash rate of return on capital is 0.5% a week or 26%. We did better than double that. We're catching up for some slower weeks. The rolls are coming with us. We're rolling now in 2-week increments because it gives us a better ability to manage the positions. And of course, we enjoyed the market going up. It was a pretty good October. But this was also, we enjoyed our own success by sticking with the stocks that we like and by generating cash. And there's the overall performance. It was excellent. We hit what we wanted to hit, and then we exceeded it. So last week, in the market, you could say that earnings are fine. And the price-earnings ratio of the S&P 500 is still regressing to the mean. Earnings went up, so the PE ratio went down, the market went up, so now there's a balancing act going on. And for many investors, meaning pension fund managers looking longer term, or traders, that regressing to the mean activity and that PE of the S&P 500 is something they don't necessarily trade or doesn't trigger, I'm going to buy 10,000 shares of Apple. But it's an important metric. And as we start also juxtaposing that against inflation, you're going to see constant moves up and down in the market. There's a Fed meeting right with us. The bond market sees an 81% chance of a 3/4 of a point increase. That's too low, and it could mean some turbulence this week. I don't know who is thinking, other than it could be that the 19% is thinking a 1%. Fed's not going to do that. And a 0.5% is completely off the table given the current strength of inflation. And so I'm putting the odds of a short-term reversal based on movements in the bond market, based on the Fed announcement, at 2-1. There are too many people misjudging the market. That 81% number should be 95. But that's not a concern to us. We're trading to our goals. We have a certain amount of capital that we're using for this service, for your other investments. We are trading to goal. So our goal is 0.5% minimum return. That's 26% a year. Because we tend to close early, I'll typically target, when opening a trade, a minimum of a 32% annualized return. So we put on 3 trades this week. SBUX, Block, the company formerly known as Square, and Charles Schwab. And you can see the annualized rates of return were almost extreme. But that is because we closed the positions early. And let me walk you through the dynamic here. This is the alert, the essentials of what we did. And this is how we closed the position. We had collected $53. I said, put out an alert. Many of you agreed with me. Let's buy it back. Now let's stop on this line here, and you'll see we bought it back for 18 or 19 cents. And I often, well, I used to years ago, get why are we spending the money to buy it back? Well, the answer is pretty simple. You would never open that trade for $19. And what's the logic here? You're giving up $19. You're paying $19. You're reducing potential profit by the end of the week. So you say that's the potential profit, right? For the end of the week, the extra 19 or 18 cents. Would I open that position for that profit of 18 or 19 cents? The answer is absolutely not. So in addition to the annualized rates of return, which were terrific, there's the common sense question. Would I open that trade for 19 cents? And the answer, of course, was no. So that was the first one we closed. The second was Square. And these were opened on Tuesday during live trading. Again, would you ever put that trade on for 8 or 9 or 10 cents? And the answer is, of course not. And so you may say, wait a minute, I'm only making $21 a contract. Well, many of you may have sold 10 contracts or 5 contracts. We do all our measurements here by 1. And again, 72% annualized basis, and that's 0.4%. So you're going, wait a minute, you said everything has got to be 0.5% or more. No. What I said was we have a target rate of return on an annualized basis of 26% a year, cash rate of return on invested capital. And we're doing far better than that. And this one, Charles Schwab was not in a live trading session. We put it on towards the end of the week. Trade that, and here's an example of rolling. We were locked into Charles Schwab. I put the trade on earlier in the year and it immediately turned against us. So we just kept rolling it. And when we closed it, the market was down 17 or 19%. The low on the stock was around 20, and we broke even. So the mentality here is protect your capital. Don't lose money when it's a really good company, which Charles Schwab is. You hang in there. And that's why we target that 32% annualized return as the initial trade, because we know those situations are going to arise. Here we put it on and we closed it the next day. Actually, Starbucks and Block we closed the next day. We closed this the next day. We're not a day trading service. I call it the one-day trader, meaning we're making believe that if we close it one day, we'll be fine, but we might run it out to expiration, or we might even roll it. So here the rate of return was exceptional. And you're looking at 3 positions, bang, 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 taking advantage of an upshot in the market or a different attitude towards the sector. With Charles Schwab, it was finance. With Square, it was payment processing. With Block, it was payment processing. And with Starbucks, it's a combination of the movement of the dollar, which makes buying coffee cheaper, a slowdown in union organizing attempts. Howard Schultz, the fading out CEO, he's fading out on purpose, and he was the founder, going around doing press interviews about the future of the company. So a lot of things came together at the fundamental level. So if you take a look at the combined gains, we hit that 0.5%. Now I manage typically by position. I mean, we have trading tactics that we have to use, guidelines for managing position we adhere to. But when I pulled the trigger and said, let's close Schwab, in addition to that great number that you saw, I said, hey, that's cool. 3 trades for the week, 0.5%. We nailed it. And what you do is you put on you put your visor on, and you're going, I want to hit my goals. I don't care if the market's going up. I don't care if the market's going down. I don't care if the market is going sideways. These are my goals, and this is the way to do it. So we had goals for these positions, and we closed them individually. But again, we had goals for the new capital that was deployed during the week. But what about the existing positions? We'll take a look. When I designed Options Income Blueprint with Dave Durham more than a decade ago, the target rate of return at the time was 15 to 18% and 10% for rolls. We upped the target rate of return to 25%. And my target annualized rate of return, when the amount of cash coming in from a rolled position, was 15 to 18%. And you take it lower because you want to stick with fundamentally sound companies that you're going to trade for a while. Well, look at those numbers. The volatility in the market plus, frankly, stock selection the number is really, really good. And that's why our 56% number for the week was so high. It was because the rolls that we're getting from these companies. Now, when you think about it, Citigroup, General Motors, Bank of America, are these speculative companies? Are these little biotechs? Are these little potash mines in Poland? No. These are big, giant, successful, market-leading companies. And yet, look at the cash generation that we're getting by rolling these stocks. This is the hybrid. Great fundamentals, really strong underpinning for the stock over the long haul, and really fabulous volatility and cash opportunities in the short run. So you can take a look. The numbers are so much on our side. So some of you who come in, I want to trade, I want to trade, I want to trade, you may be doing the second leg of these rolls, and always send me an email if you have questions. The bottom line here is cash. Cash divided into capital is cash divided into capital. Rates of return are rates of return. And your annualized rates of return here are outstanding, given the strength of these companies in the real world. And so please don't forget, that cash goal. I speak annualized rates of return as the tool used to manage positions, to create positions, to close positions. But you're here to generate cash, even if you're reinvesting, which most, if not many people, most people do. But by focusing on cash, you're avoiding the tumult of the market. You're going, I'm not worried about Friday at 4 o'clock. I did my 0.5% in cash this week. And if I do that for a year, I'm going to beat the market. If the market's down 20 and my core capital is down 20, I'm actually up 5. So I'm going to beat the market by a wide margin. So even if you're reinvesting, cash is a really big deal. Now, with the week coming up, we're just waiting out the Fed. Tech continues to shake out, and I have a bone to pick with media and analysts. Google's not a tech company. It's a media company. Facebook is not a tech company. It's a media company. Netflix is not a tech company. It's a media company. So when they say big tech gets hit, they lump together these companies with Apple, which is a tech company. So when I say tech, I mean tech. I mean the tech that Wall Street is viewing, Google and Facebook and whatever, is not what I'm viewing. I'm talking about Apple and chips. And big numbers this week will be coming out from Pfizer and Moderna, the two dominant COVID vaccine manufacturers, about what's going to happen next year. Infections are rising. There's new variants. There's new boosters for variants. I want to hear what they have to say. We trade Pfizer here. We trade Pfizer and Moderna in the Income Masters program. They're both quote-unquote underwater from the original position, but they generate gigantic amounts of cash over the course of time, and so forth and so on. So they're important to watch because they are not going to necessarily move biopharma, but they're heavily traded stocks. And the questions we ask as we go forward: is the bond market too optimistic? Yes, about the Fed. Will inflation concerns hit holiday spending? Not overall. There was a fascinating article in the Robin Report, which is a free retail report about retailers, and there's a group called the Henrys: high earning, not yet rich, not rich yet. They're beginning to shift into what I call the new frugal, which I've been trading for 10 years. Fewer stuff for Christmas, more expensive, high quality items. It's validation of what we've been doing here for a long time. So I don't think inflation concerns will hit overall holiday spending. I think it's going to shift monies around, and we will trade that. And will the election matter? Barring a Republican takeover of this, a clear Republican takeover, meaning if Evan McMullin wins in Utah, he's an independent. The question will be who. He's a lifelong Republican. He's running as an independent. Will he caucus with the Democrats or caucus with the Republicans? Right now it says, the polls say, Senate probably Democrat, House almost certainly because of gerrymandering, the Republicans. Will it matter? I personally don't think we can make a judgment yet. If for some reason the Republicans won the Senate and the House and didn't have to worry about McMullin, then you would assume that there'll be a much more conservative federal budget, and that won't necessarily be good for specific companies. So we'll see. I think after the election, which is a week from tomorrow, we'll be able to discern what Wall Street thinks. This is Michael Schulman. Thanks for listening.